In this case study, we're looking at the global financial crisis, which occurred in 2008, 2009, so quite a few years ago now. The global financial crisis is an interesting one. If you ask most people, non-economists, I guess, what caused the global financial crisis, they would probably talk about Wall Street and subprime lending and the investment banks and credit rating agencies. And while no one thing caused the global financial crisis, certainly all of those things contributed. But from an economic perspective, from a macroeconomic perspective, there's some more fundamental drivers or causes of the global financial crisis than the ones that I just listed. So we're going to start off with some of those more fundamental causes. Okay, so in this slide, the question is, what are the origins? So in this slide, the question is, what are the origins of the global financial crisis? Well, with hindsight, we can now trace the global financial crisis back to the Asian financial crisis, which started in Thailand in July 1997 and then quickly spread to Malaysia, Singapore, and other countries of Southeast Asia. Now, I'm not going to go into the causes of the Asian financial crisis. You're free to sort of read up on that on your own, but the causes are not important for this case study. But what is important is to understand that the Asian financial crisis, basically what happened is a couple of banks collapsed, one in Thailand, one in Malaysia, and that then set off a lot of a panic, a big panic. And that panic then led to very stagnant growth, high unemployment, and probably most importantly, a collapse of the exchange rates. And you can see in this chart, around about 1997 into early 1998, there was a massive depreciations of the currencies of select countries in the East Asian area. So if you have a look at Indonesia, dropped from an index, the exchange rate dropped from an index of about 100 all the way down to 20. So that's an 80% depreciation of Indonesia's exchange rate. The depreciations of other countries were more moderate, but even Korea experienced a drop of around about 40%. So they're massive depreciations. So as a result of the Asian financial crisis and the subsequent recessions in those economies, the question then becomes, well, what caused the exchange rates of these countries during the Asian financial crisis to collapse? That is complicated, but we're just going to keep it very, very simple. And one of the main drivers of the collapse of the exchange rates was investors selling their bonds and shares and other financial assets and even real estate in these countries in this chart and withdrawing the money out because the whole area was in crisis. So if you're an Australian and you own bonds issued by the Korean government, the idea is as soon as the crisis emerges, you sell those bonds, withdraw the money out of the country and put it into a safer currency. Because what you're really fearing is even further depreciations of the exchange rate or capital losses on the assets themselves. So there was a lot of assets being sold in these countries, and the money was being moved out of the region to safer destinations. And of course, that is then going to lead to an increase in the supply of these countries' currencies in the foreign exchange market, and also a decrease in demand because foreign investors were no longer interested in buying these currencies to buy the financial assets of these countries. So decrease in demand, increase in supply caused the depreciations that you can see in this chart. The effects of these exchange rate collapses, two of the main ones are all of a sudden import prices will be far higher. And just imagine in Indonesia with an 80% drop in the value of their exchange rate, imagine what that's going to do to import prices. It's basically going to increase import prices by a factor of 5 times. So all of those vital supplies, medical equipment, high-tech machinery that Indonesia needs, all of a sudden, overnight, well, not quite overnight, but over the course of several months, became 5 times more expensive as a result of Indonesia's depreciation in the chart. And the other major problem here is that any of these countries or any organisation in any of these countries that had debt in foreign currency, all of a sudden that debt becomes very difficult to repay. Okay, so that's the main effects of the exchange rate collapse. So now I haven't told you how this Asian financial crisis then contributed to the GFC, but we're certainly getting there in the next few slides. Okay, next thing. Just after the Asian financial crisis, there was an inflow of foreign investment money into the US. And so a lot of these East Asian countries, what they began doing, particularly the central banks and the governments of these countries, they started building up foreign exchange reserves. And the asset of choice was bonds, and the currency of choice was US dollars. So these countries and the central banks and governments of these countries in particular, as well as superannuation funds, investment funds in these countries, started buying US bonds, mainly government bonds, but then a little bit later in the mid-2000s, they started buying corporate bonds, particularly bank bonds. So why were these countries all of a sudden, after the Asian financial crisis, turning their attention to accumulating foreign exchange reserves? And remember, a foreign exchange reserve is when you hold, as a country, you hold large quantities of a foreign currency. And the asset of choice in terms of how you hold that currency is bonds. So if you have a US bond issued by a corporate, by the government, the idea is you can quickly sell that bond, get US dollars, and use those US dollars. So why were these countries accumulating US dollars, in effect, foreign exchange reserves? Because there was so much damage caused by the depreciations of these exchange rates just during and after the Asian financial crisis, that these countries realized that they needed to build up foreign exchange reserves, that is, holdings of US dollars and US dollar denominated assets, so that if the region went into a crisis again, they would have US dollars to combat the depreciations of their exchange rate. Now, at the time of the Asian financial crisis, these countries in the chart didn't have large holdings of US dollars. If they had of, they would have been able to use those US dollars to buy their own currency and support its value, support the exchange rate during the crisis and prevent the exchange rate from dropping so far, but they didn't. And so that's why after the Asian financial crisis, they made that decision, these countries made that decision to start accumulating foreign exchange reserves. And so not only did the money flow in from the countries involved in the East Asian financial crisis, but at the same time, I think China and the countries in the Middle East too began accumulating US dollar reserves, official reserves. And you can see it here in this chart. So the East Asian financial crisis started in, or occurred in 1997-98. And this is total US Treasury and agency debt. Don't worry about agency debt. US Treasury bonds held by foreign holders. And so you can see what happened after 1998, which is kind of when the Asian financial crisis ended, although the economic impacts lingered for many years afterwards. From about 2000 onwards, you can see a massive accumulation or a massive increase in the amount of US Treasury bonds, as well as corporate debt as well, that foreigners held. And so this is sort of annual purchases by foreigners. So these flows, so it's not a stock of debt held by foreigners, it's annual purchases. So you can see that the annual purchases by foreigners of US bonds increased from about $1.5 trillion after the Asian financial crisis, and by 2005 it had hit $3 trillion. So that is over, and you can actually see the change each year. So the difference between 2000 and 2005 is an extra $1.5 trillion in 2005 of US bonds being purchased by foreigners relative to the year 2000. So what we're witnessing here is just hundreds of billions, if not a couple of trillion dollars of additional foreign investment money pouring into US bond markets. You can see it right there in front of you. Okay, so these columns, once again, are purchases of US bonds by foreigners, and that increased substantially after the Asian financial crisis. What's that got to do with the GFC? We're getting there. Okay, this additional flow of savings around the globe into primarily US bond markets was named by Ben Bernanke. That event was called the Global Savings Glut. So what Ben Bernanke was, and there's a reference for you to read a little bit more about that at the bottom of this slide, what he was talking about was the huge amount of additional savings from Asia, China. I know China is part of Asia, but I've separated it out before, and the Middle East. So East Asia, China, Middle East, primarily those countries, the additional savings pouring into the US. He called it the global savings glut. There was just so much savings coming from these countries and pouring into primarily the US. Now, of course, that would lower long-term interest rates, because if you've got additional savings coming from East Asia, from China, it was coming from Japan and other places, but the Middle East as well, it's going to increase the supply of loanable funds globally, particularly in US bond markets. And when that happens, interest rates fall. So it's interesting to sort of look at what happened to US interest rates and compare US bond rates just before the Asian financial crisis and then in the years after. And we'll use this chart. What we've got is 10-year Treasury, US Treasury, so government bonds in the US. And just before, we have a look at around about 1998, 99, around about 2000, those rates hit a peak. So I'm looking at this point here. It's a couple of years after the Asian financial crisis, because it did take a couple of years for these flows of money to actually move into the US. They didn't start in 1998 or 1999. If you have a look at the data, they started sort of 2000, 2001, etc. So we would expect interest rates in the US to start falling from about 2000, 2001 onwards. So let's have a look at 2000. The yield on 10-year treasuries right there is about, what, 6.8%. And in the next sort of 4 years, they got driven down to a low of around about 3.2 to 3.4%, but then hovered around this level, about 4%. So we're seeing interest rates in the US drop by, and I'm comparing this point of about 7%, about 4% there, by roughly a 3% drop. And that's what Ben Bernanke was talking about. Global savings glut, huge amounts of money pouring out of these countries into the US and driving US interest rates down. Now we're kind of getting closer. We're getting this sense that in the years leading up to the GFC in 2008, 2009, banks, as well as the US government, could borrow money at much cheaper rates because of this global savings glut, because of the money pouring out of East Asia in particular, and also the Middle East and China, which had its origins in the East Asian financial crisis. So now this column here, which is shaded, that's the global financial crisis. This is the recession of 2001. so the dot-com bubble in the US, and these are the low interest rates, around about 3.5% to 4.5% in the US leading up to the GFC. Now you may say, well, 3.5% to 4.5% is not that low, is it? But remember, they're nominal interest rates. So you'd need to look at what the inflation rate was in the US. So if you then subtract off an inflation rate of maybe 3%, you're looking at real interest rates of 0.5% to maybe 1% over this period. So very low real interest rates in the US. That obviously is going to feed through to very low mortgage interest rates. So we're kind of getting closer to the US housing sector now. Okay, global imbalances. Global imbalances is something which you can sort of read up on your own. It's just a small part of the global financial crisis story. But what this diagram shows is the amount of money that was flowing out of certain countries and into other countries. So we've got current account balances here. And down the bottom, we've got, if you have a look at the color code, we've got the US and big parts of Europe running current account deficits. Now, you'll remember from early on in this course, if a country's running a current account deficit, it must be receiving foreign savings from other countries. It must be running a capital financial account surplus. And what you can see here is from 1998 to around about 2000, well, in the case of the US, 2006, there was quite a substantial increase in the size of the current account deficit. It went from, in the US, around about 8% of global GDP, and the current account deficit blew out to there about 1.6% of global GDP. That's just the way this chart is being measured as percentage of world GDP. So if we actually converted that increase in the US current account deficit into US dollar figures, then the increase from 0.8 of world GDP in 1998 to 1.6 in 2006, which is sort of just 18 months prior to the GFC, if we converted that to the US dollars, we would see that that is an increase of hundreds of billions of dollars. So each year, the inflow of foreign investment money was just getting bigger and bigger and bigger, leading up to the GFC. And of course, that was then driving larger and larger current account deficits in the US. Up the top here, we've got the countries that were sending money to the US. So it was, if you have a look at the color coding, it was the oil exporting countries, Germany, Japan, and also China and other countries of Southeast Asia, the countries that it went through the Asian financial crisis. So what we're getting from this graph is a sense that the countries on the left here in green and grey, they were the ones with excess savings, and they were sending that money primarily to the US, but a little bit of extra money to Europe as well. Okay, so what did America do with all of this money that was pouring in to its bond markets? The money was pouring into its bond markets because foreigners were desperate to accumulate foreign exchange reserves. Now, it was the countries of East Asia that built up, wanted to hold US dollars to protect their currency. But even China was wanting to increase its holdings of foreign exchange, particularly US dollars. That's more of an exchange, a Chinese exchange rate issue. But then countries of the Middle East as well, they were holding US dollars as well. And the countries of the oil exporting countries were actually building up foreign exchange reserves to protect their currencies to a large extent as well from similar sorts of shocks that hit the currencies of East Asia. So anyway, money was pouring into the US bond markets. The US government borrowed part of this, but a lot of it started going into the banking sector in the US. So these foreigners were buying not only US government bonds, but increasingly US bank bonds. Banks were viewed as being quite safe. The bonds had a face value expressed in US dollars, so the foreigners were in effect holding safe assets denominated in US dollars, so they were reasonably happy. And this foreign money poured into the US. We're talking about increases in the amount of money that was flowing in of hundreds of billions of additional dollars each year. And when you've got foreign investment money to the tune of hundreds of billions of dollars extra each year pouring into the US, that money is going to show up somewhere. The effects of that inflow is going to show up somewhere. It turns out it showed up in the US housing market, because what happened was US banks started borrowing a lot of this money. Why? Because it was being offered to them by foreigners at very low interest rates. Come back here, we can see that just after, or in the early 2000s, the US banks could borrow money at, well, this is US government bond rates, so bank rates would have been slightly higher, but they could borrow money at 3.5 to 4.5% from these foreigners. And remember, what was the real rate over this period? It would have been extremely low. So the banks saw these very low interest rates over this period. I mean, obviously since then, as a result of QE, the rates were pushed down even lower. But in the context of history, these rates in the early to mid 2000s that the banks could borrow money at from foreigners were the lowest in 50 years. You can see it from the graph. So the banks viewed these low interest rates that I'm sort of pointing at with the cursor as a golden opportunity. So the banks borrowed this money. And what they did with it, they started lending to their customers at favourable interest rates. If they were borrowing that money at, say, 3.5%, they could lend it out at record low interest rates to their customers. And so much of the money was borrowed by US banks and funded prime lending initially. So a prime borrower is someone with a secure job, a history of stable income, and very good credit rating. Someone that is reliable, they are a good borrower, they're a safe bet for the bank, a low-risk customer. And so the money each year was borrowed by US banks, hundreds of billions of dollars, and loaned out. And these prime borrowers started borrowing this money and investing it in the property market. New houses were built, and the price of existing houses were pushed upwards. Now you've got to remember, this is the early to mid 2000s, but this really accelerated from about 2003 right through to 2008. Sort of a 5-year golden period where the money was pouring in, hundreds of billions of additional dollars. US banks were borrowing this money and lending it to their customers. Now, one possibility is the customers could have borrowed that money and purchased shares. Dividends on the shares service the interest payments on the loan. It could have happened, but it didn't happen that way because in 2001, the dot-com bubble in the US stock market burst and people lost a lot of money in the stock market. So people were in the early to mid 2000s, even in the late 2000s, were very cautious of re-entering the stock market because it had collapsed in 2001. So individuals, rather than borrowing money from banks and investing it in the stock market, were investing it in the property market. And so all of this prime lending occurred. But then eventually, it was around about 2005, 2006, all of the prime lending dried up. All of the prime borrowers, those responsible borrowers, they were kind of maxed out in terms of how much they wanted and how much they could borrow. But the problem is the money kept coming. And foreigners kept throwing this money at low interest rates at the banks. There was a constant demand for bank bonds. And so the banks thought to themselves, well, we've undertaken all of the responsible lending, but these foreigners are enticing us to borrow even more at record low interest rates. That's when subprime lending began. And subprime lending, well, a subprime lender is the opposite of a prime lender. Someone with I guess, a questionable employment history, someone with unstable income flows, someone who's just a bit too very risky for the banks, someone that the banks wouldn't have loaned money to in the years prior to the Asian financial crisis. Because the banks realized that they had a golden opportunity of borrowing this money, lending it out at low rates to these subprime lenders, and they just wanted to continue to make money. So then I guess one question is, well, how were the subprime borrowers enticed to borrow money? Now, I've read a bit about this, quite a bit about this, and there's some interesting stories that come out of the period from about 2005 through to 2008. This is the time where subprime lending, which is mortgage lending to very dodgy borrowers, really exploded. So how are these subprime borrowers enticed? Well, I did read one story of one salesman. Now, this guy, from memory, he came out of the car industry and he was enticed into the mortgage industry, and he became a salesman of mortgages. And what he would do is he would go around to the trailer parks in the United States where people are living in basically caravans. And he would knock on someone's door and he would say, I represent such and such a bank, and I can organize a mortgage for you. Let's say $200,000 for you to buy a house. The way that loans were structured was that for around about the period of time did vary from bank to bank, but roughly 2 years, these customers were offered a very low interest rate, a teaser interest rate. And so an interest rate which was basically much lower than the regular variable mortgage interest rate at the time. So if the regular mortgage interest rate was, say, 6%, then they were offered, let's say, 3%. And they were offered a 3% interest rate for 2 years. Now, this looked very enticing to a lot of these subprime borrowers that were living in caravans at the time, because the way it worked out is the loan repayments were actually lower than the rent on the caravan that they were living in. So they could actually get into their own home and pay a smaller mortgage payment each month than the rent they were paying on their caravan. So that was very enticing. So a lot of them just jumped for that offer. And I guess many people weren't even sort of financially savvy enough to think about the future. This was just a short-term gain. It was just an opportunity to sort of reduce the costs of shelter, I guess. Now, with these teaser interest rates that the banks were offering, these low interest rates, they were for about a period of about 2 years. Some of them a little bit longer than 2 years, others a little bit shorter than 2 years. But then after 2 years, the interest rates reset up to quite high levels to reflect the riskiness of the borrower. And from what I read, I'm still talking about the same salesman that came out of the car industry. From what I read, many people didn't even realize that those interest rates did jump up. It was in the paperwork, but a lot of people just signed the form and didn't even realize after 2 years the interest rates that they were paying would ratchet up to a much higher level. But for the few people that did read the documentation and then discovered that interest rates in 2 years' time would jump up, the salesman had a really good answer, because these people were obviously concerned they wouldn't be able to pay those higher interest rates. salesman had a really good answer. What he said was that real estate prices in the US always rise. And in fact, that was true leading up to the early 2000s. Throughout the 60s, 70s, 80s, 90s, housing prices had always increased. And so based on that, what he told the people was that don't worry about interest rates jumping from 3% up to say 6 or 7%, because when that happens, you'll have 2 years over which your property will have increased in value. And so then we'll lend you, say, $200,000. You'll buy a house for, say, $200,000. I'm just using round numbers for convenience. But in 2 years' time, your house might be worth, say, $220,000. So what the salesman said is that now you'll have $20,000 equity in your house, because the home will be worth $220,000 and your loan will be worth, well, slightly less than $200,000 because they would have paid down some of the principal in that 2-year period. So you'll have $20,000 equity in your home. You are now less of a risk to the bank, so you'll be able to go into the bank and negotiate with this equity, this $20,000 of equity, a lower interest rate. So don't worry about the 6 or 7% interest rate. You'll be able to negotiate a much lower rate. And that was enough to get many people to just sign the form and undertake the mortgage. The problem is, while housing prices, while borrowers, the home buyers in the US, were told that housing prices always increase over time, over that period in the 2000s leading up to the GFC, they didn't increase very much at all. So these subprime borrowers didn't have the $20,000 equity in their home that they may have expected. They weren't able to go into the bank and negotiate a lower interest rate because they didn't have the equity they had maybe assumed would occur. And so these people were all of a sudden in trouble. They'd moved out of their caravan into their own home, but now interest rates started jumping up. They couldn't make those higher repayments. So that's when housing prices started to fall. That's when defaults started to occur. Defaults on mortgages started to occur. So people stopped paying their mortgages because they just couldn't afford them. People were getting kicked out of their homes, and defaults began. Continue the story. So what triggered the GFC? It was actually the reset of the very low teaser interest rates that these subprime borrowers were offered. And what I've got in this graph is I've got the volume of different types of lending. So we've got prime lending, agency lending, which is generally quite secure lending, but then there's Alt-A, subprime, and adjustable optional arm rates, they used to call them. So the top three are very risky types of borrowing. The columns are monthly data, and on the vertical, we've got billions of dollars. And this shows the date at which these loans reset. The date at which, or the month at which these loans were resetting. So what it's got here, if we have a look at, say, January 2008, just above my cursor, it's a bit difficult to do this, but we take it up. We can see that figure there, January 2008, we take it across, roughly $25 billion worth of mortgages reset, and people had to start paying higher interest rates. But look at the subprime mortgages. The size of these columns in the light green, starting from about 2007, going all the way through 2008 into 2009, each month, $20, $30 billion of subprime mortgages reset from the low teaser rate to the much higher interest rate. And so this big, massive light green here matching the subprime, that was when the GFC started to kick off. Okay, so I guess what we're seeing from this graph is all these subprime borrowers, and we've got the volume or the value of the mortgage debt, the value of the loans here. So we've got hundreds of thousands of subprime mortgage borrowers with tens of billions of dollars of mortgage debt monthly were experiencing resets in their interest rate. And reset is just another way of saying the interest rates on their mortgages were jumping. So all of these people, subprime borrowers, they were walking away from their home loans. The banks were repossessing their homes. Each month, the banks were repossessing $15, $20, $25 billion worth of homes and selling them to try to recover the money. Of course, that's going to push housing prices down. So that's what was going on in the mortgage market. But the next question then is, well, how is Wall Street involved in this mighty mess? Well, Wall Street no doubt made it a lot worse and spread. Well, it was really Wall Street that made this crisis global through the creation of something called a mortgage-backed security. Now, the problem with this subprime lending is that the banks, and it would have been the US version of Westpac, Commonwealth, ANZ, just the normal commercial banks, these subprime loans represented risk on the balance sheets of these commercial banks. Because if you lend money to a subprime borrower and you hold the mortgage, then if that person defaults on their payments, that mortgage turns into a house, and you've then got the challenge of selling that house and recovering the money that you have loaned to that subprime lender. That's the risk, that you may not be able to sell the house for enough money to recover the amount of money you loaned to that person. And so the banks really were keen to find a way of removing this risk from their balance sheet. And the only way you can remove the risk of a risky mortgage from your balance sheet is sell it to someone else. And so this is what Wall Street was doing. So what we've got here is sort of an infographic in which the banks provide a mortgage to the property buyer, and the property buyer pays interest and principal repayments to the bank. But the banks didn't want to hold all of the subprime mortgages. The prime mortgages were okay, they were less risky, but the banks, they had loaned money to a lot of very questionable borrowers. So what the banks then did, they sold those mortgages to Wall Street. And Wall Street pooled all of these mortgages together. So when I say the banks sold the mortgages to Wall Street, what I mean is the banks sold the mortgages to investment banks, big investment banks in the US. If you don't know what an investment bank is, just have a quick look. Do a quick search on investment banks in the US and you'll get a sense of what they do. Now, these investment banks were buying the mortgages off the banks. So they were paying an amount for the mortgage. The banks then moved the mortgages off their balance sheet and got cash in return. So with the cash, the banks could then continue lending to a new customer. And each of the parties made money out of this deal, obviously. So Wall Street gathered all of these mortgages together and created something called a mortgage-backed security, and then sold the mortgage-backed securities to investors. These mortgage-backed securities paid a return, 6, 7, 8, 9%. So investors were actually buying this new financial product called a mortgage-backed security that was created by Wall Street. And that financial product had value because it was backed by mortgages. So in a sense, the investment banks were holding on to the mortgages, and those mortgages were backing or creating the value that the mortgage-backed securities actually had in the eyes of the investors. So as an investor that was buying a mortgage-backed security, and who were these investors? They were from all around the world. Even right here in Perth, the city of Melville, this came out in around about the year 2010. Some of you will be living in the city of Melville. The city of Melville bought some of these mortgage-backed securities from US investment banks. Now, obviously, they lost a lot of money out of that, but we'll get to that later. What I'm emphasizing is that these investors that were buying these mortgage-backed securities, and I'll explain to you exactly what a mortgage-backed security is in a little while, they were coming in from all over the world, these investors. These mortgage-backed securities were offering quite a good return. So the investor, what they were effectively doing was buying a new financial product. And I'll describe what the financial product was in a little while. And that financial product, it's called an MBS, and it paid an annual interest rate of 6-7%, 8% in some cases. So the return was potentially quite good for these investors. But these assets that were being created had value because they had mortgages backing them. So as the homeowner paid interest and loan repayments, they would pay them to the investment banks, and the investment banks would collect all of that money and use that money to pay the investors their 6 to 7 to 8%. The banks made money, the investment banks made money, the investors made money, and the subprime and prime lenders, well, the subprime lenders, I guess, got into a home temporarily. Okay, so what is a mortgage-backed security? Just imagine you're an investment bank. You're trying to find a way to make money. So what you do is you go to a lender. You issue a bond as an investment bank and you borrow money off lenders. And maybe you borrow $1 billion. Now remember, this is not a retail bank, it's an investment bank. Okay, the closest we have to that in Australia would be Macquarie Bank. Investment banks generally don't deal with individual customers, they deal with big clients, companies, that sort of thing. And their business model is kind of more financial advice, big lending, as well as creation of new financial products to suit customers' needs. So you're this investment bank in America and you've borrowed $1 billion. What do you do with that $1 billion? You buy mortgages. Now you own the mortgages and you use the $1 billion to buy the mortgages. And so a mortgage is an asset because you'll be borrowing the money at a lower interest rate than the return on the mortgages, and you'll make a profit margin on that. The mortgages have security. The security of the mortgage is the home itself. So you've borrowed $1 billion, you've bought $1 billion worth of mortgages. But the problem is the investment banks knew that holding all of these mortgages was just a little bit too much risk for their liking. So they bought the mortgages, but then they wanted to move the risk of these mortgages, particularly the subprime mortgages, off their balance sheet. So what they needed to do is kind of find a way to sell these mortgages on to someone else. And that's where they started looking at all of these investors around the world. But Wall Street certainly couldn't go to an investor like the city of Melville and say, we have a 3x2 house in the hills of Colorado, would you like to invest in that house? No investor's going to be interested in that. It's just too risky. So they had to find a way of effectively, the investment banks had to find a way of effectively selling these mortgages onto investors, but make sure that the investors felt quite secure in the investment that they were making. So what the investment banks did is they took this $1 billion worth of mortgages and they pulled them all together and created a mortgage-backed security. Now, $1 billion, remember, is 1,000 million. And so what they did with this mortgage-backed security is created this financial product. So we've got individual mortgages, they're all pulled together, and we've got $1 billion worth of mortgages that we've purchased with $1 billion worth of money we've borrowed. So then what you can do is you can use this $1 billion worth of mortgages to create a mortgage-backed security. And this is the security here in blue. And this security is backed by mortgages, mortgage-backed. So this security has value because it is backed by the mortgages. And so we've got, let's just keep the numbers nice and easy. We've got now a mortgage-backed security, this blue thing, which has a total value of $1 billion. And investors start buying little pieces of this mortgage-backed security. So what you do as the investment bank is you buy all of these mortgages, you pull them all together. You've got all of these mortgages sitting on your desk. And then underneath your left hand, pile of mortgages, $1 billion worth. And underneath your right hand, you now create a mortgage-backed security. And they're sitting next to each other because the mortgage-backed security is backed by the pool of mortgages. So what does this mortgage-backed security, this blue thing, actually look like? Well, it's worth $1 billion. And so you're not going to sell the full security to one investor. So what they did is they actually sliced it up. And let's just say, for convenience, that they sliced it up into 1,000 different little parts, each worth $1 million. So just imagine a little corner of this bottom part of the mortgage-backed security, a little corner worth $1 million. So an investor comes along and they buy that little corner of the mortgage-backed security, $1 million. And then other borrowers buy up $1 million pieces of the mortgage-backed security as well. So now what you've got is 1,000 investors. Of course, one investor could have bought a chunk of these, but I'm keeping it simple. So you've got 1,000 investors have now each paid $1 million for their 1,000th share of this mortgage-backed security. So what you're in effect owning, if you've handed over $1 million to buy one of these things, you're owning a 1/1000th of this mortgage-backed security. The homeowners then make their repayments, go to the investment bank, and the investment bank then pay you interest, the 6-7%. And so this is the way that Wall Street purchased mortgages, pulled them together, created a completely new asset, and they sold the blue asset, the mortgage-backed security, off to individual investors, which is what was happening here. The investors were buying small chunks of each mortgage-backed security. So in effect, the people now holding the risk of the mortgages were these investors, not Wall Street. So the banks undertook dodgy lending. They didn't want the risk, so they sold the mortgages to Wall Street. Wall Street didn't want the risk either, so they created mortgage-backed securities and sold them to individual investors such as the City of Melville. So really, the US banks and investment banks were handballing this risk onto individual investors all around the world. The investors faced risk because if one of these mortgages defaulted and the investment bank then had to repossess the house and sell it, and possibly sell it at a loss, then let's just say the original mortgage of this top house was, say, $200,000. Let's just imagine the bank had to repossess it and sold it for $150,000. You've just made a $50,000 capital loss because you paid $200,000 for the mortgage, but you've now only recovered $150,000. You've made a $50,000 loss. Who incurs that loss? It's the owners of the mortgage-backed security. So they may have handed over $1 million, but now their $1 million share in the mortgage-backed security that they purchased is worth less because of the default of this house. Obviously, the loss of this house would have been shared across the different owners, but the owners would have lost money. The investors in the mortgage-backed security would have lost money. The problem is massive defaults. Housing prices plummeted. It wasn't just one or two houses or mortgage holders that defaulted, and not one or two houses that were sold at a loss. It was thousands and thousands of houses across America, tens of thousands of houses. It probably even got up to hundreds of thousands of houses. So quickly, these mortgages were turning into houses as people defaulted. Losses were being made. The full amount of the mortgage couldn't be recovered. And these investors who bought the mortgage-backed security, they then started to make losses. Now, an interesting feature of these mortgage-backed securities was that they actually cut the complete mortgage-backed security into different tranches. So we've got 3 tranches here. Tranches are just different levels of a mortgage-backed security, which offer different returns and have different risk. And down the bottom, subprime is an unfortunate term. They generally weren't called subprime parts of the mortgage-backed security, but we'll ignore that. So this bottom part of the mortgage-backed security, if you bought a $1 million part of this bottom bit, you would get paid a higher interest rate. However, if you bought a $1 million part of this top part of the mortgage-backed security, so it's just a different part of the mortgage-backed security that you're buying, you would get a lower interest rate. Why? Because you'd get a higher interest rate if you bought a $1 million part of this bottom part of the mortgage-backed security. You get a higher interest rate because this bottom part exposed you to higher risk. So what Wall Street did, the way they set up these mortgage-backed securities, is that if these houses or the homeowners defaulted on their repayments and the mortgage turned into a house and a loss was made, a capital loss was made in selling the house and trying to recover the money, then it would be people in this bottom tranche that lost their money first. So for these people in the mezzanine tranche, for them to lose money, all of the people in the bottom tranche, they would have to lose their money first. Now, how would you lose $1 million in this bottom part? Just have enough houses which are backing your particular mortgage-backed security, have enough of these houses default. The bank then repossesses the house. A loss is made on the house because housing prices are falling. And so you've got these capital losses, And then the investment bank comes along to you and says, well, sorry, we've just been making losses on all of these houses. The $1 million share that you used to own is now worth nothing, and you've just lost all of your money. Hopefully that makes a bit of sense. And the only way the high quality people, the people in the high quality tranche could lose their money is if all of the value in the bottom tranche was wiped out by housing market losses, and then all of the value in the mezzanine was wiped out as well. So it was believed that there was no way that housing prices could ever fall enough for the people in this top tranche to ever lose their money. You would need housing prices absolutely collapsing, probably by 70%, for these people in the top tranche to actually start losing money. So the credit rating agencies, who actually worked and were paid by the investment banks to rate these mortgage-backed securities, happily rated this top part AAA, as safe as US government bonds, which in hindsight was an absolute farce. The US regulators weren't even watching this. This mortgage-backed security industry wasn't even on the regulators' radar screen. So all of this was happening right under the nose of regulators, but they didn't even know that they needed to look at this because it was new. And yeah, as I said, it just wasn't something that they realized that they needed to sort of watch. So we had the credit rating agencies in America rating the top tranche AAA, the mezzanine sort of BBB, and the bottom tranche could have been rated at a much lower level in terms of credit rating. And a credit rating is just represents the safety of the asset. So we had a very risky components of the mortgage-backed security here, very safe components here. Okay. So then what happened? Well, Wall Street got into a lot of trouble because all of these subprime loans began to reset. Huge number of subprime borrowers walked away from their homes. Housing prices began to collapse. So all of the market value of these houses, which were backing the mortgage-backed securities, they began to collapse as well. So all of a sudden, in reality, you didn't have enough value in these houses to back the mortgage-backed security, of which was originally sold for $1 billion. Originally, you had $1 billion worth of mortgages, but these mortgages started incurring capital losses. People were making losses on the mortgages. The investment banks were making losses. And so they didn't have the $1 billion backing the mortgage-backed security anymore. So what happened? Well, investors slowly put two and two together. And these people, the savvy ones, looked at what was going on, housing prices collapsing. They thought to themselves, well, hang on, I own a mortgage-backed security and it's backed by a house in America, and housing prices are collapsing in America. So of course there was a rush for the exit in terms of these investors, and they started selling these mortgage-backed securities. A lucky few did, but quickly everyone caught on that these mortgage-backed securities were backed by houses and mortgages on those houses, and houses were collapsing in price. And so all of a sudden, these mortgage-backed securities became absolutely untouchable. The investors just could not sell them. But Wall Street got into trouble because as this was happening, as the mortgage-backed security market was collapsing, Wall Street was creating new mortgage-backed securities. So at a point in time, these investment banks on Wall Street, they had borrowed billions and billions of dollars, and they were in the process of creating new mortgage-backed securities to then sell those securities to investors. But then the GFC hit, everyone began to realize the toxicity of the mortgage-backed securities, and no one wanted to buy them anymore. So Wall Street had borrowed, the investment banks, each investment bank had borrowed tens of billions of dollars, more like, well, I think it's closer to hundreds of billions of dollars, but at any point in time, it was kind of tens of billions of dollars that they were or had borrowed, the investment banks. They had used that money to purchase the mortgages, but the mortgages were now collapsing in value. The lenders of the money to the Wall Street banks came along to the banks and said, well, we want that money we loaned you back because we suspect you're using that money to create and sell mortgage-backed securities. We want our money back now. So the investment banks were stuck. They had, at each investment bank had tens of billions of dollars money borrowed. The lenders wanted their money back. And the only way the investment banks could actually pay that money back would be by creating mortgage-backed securities and selling them to investors, but the investors have stopped buying mortgage-backed securities. So the Wall Street banks were stuck in a big way. The investors wanted their money back, the money that the investment banks had borrowed to buy mortgages to create even more mortgage-backed securities. Investors, the lenders wanted their money back, but the investment banks didn't have that money because they had spent it on mortgages. They couldn't sell the mortgages, and they couldn't sell the mortgage-backed securities that they were creating, which were backed by the mortgages. So one big investment bank went under. The others got into significant amount of trouble. And then from there, it really started to spread around the world. So then the Fed, the final part of this story, we're almost there, the Fed stepped in and they started quantitative easing. Now in the US, they've had up until now 4 rounds of quantitative easing. QE1 was the first round. And in the first round of quantitative easing, the Federal Reserve, this is the Federal Reserve's balance sheet, you've seen this before, they printed electronic money and they used that money to buy mortgage-backed securities right there. How much did they buy? $2.7 trillion of mortgage-backed securities. 2.7 trillion. That's $2,700 billion of mortgage-backed securities. But it wasn't, who did they buy it off? These mortgage-backed securities? Well, part of them they bought off the investment banks to get those toxic assets off the balance sheets of the investment banks. But the problem is commercial banks around the world were holding these mortgage-backed securities as well. Normal commercial banks. So the Federal Reserve in the US had to start buying these toxic mortgage-backed securities, which the market for which had just frozen. Anyone with a mortgage-backed security could not sell it. And the market value of these mortgage-backed securities had just plummeted to virtually zero. If there are no buyers, the value of your asset is zero. And so they had to start buying these mortgage-backed securities off commercial banks as well. All in 2.7 trillion. That was the first phase of quantitative easing in the United States. Now from there, in terms of the global financial crisis, it really became global and it became a bank-focused crisis because the investment banks were in the process of creating new mortgage-backed securities and trying to sell them. They got stuck, and banks around the world were holding a lot of these mortgage-backed securities as well. Why? Because they were rated AAA or very good They were given very good credit ratings by the credit rating agencies. Presumably the banks would have gone after this high quality, low risk part of the mortgage-backed security. So banks were holding that. It was rated, the top parts of the mortgage-backed securities were rated AAA, and it paid a good return. So yeah, of course, banks all around the world were holding this. So then what happens? The spotlight went from the Wall Street investment banks to banks around the world. The problem is banks borrow money constantly. You know that, using short-term debt instruments, long-term debt instruments. And so people were even looking at the ANZ Bank. And I was talking to an employee of the ANZ Bank that was in their lending section at the time that this kicked off. And people around the world were even looking at Australian banks, wondering, does the ANZ Bank own any mortgage-backed securities that they could potentially make a loss on? And if so, how much do they hold? Do they hold 500 million or $1 billion or even more? People just didn't know. So it's almost as if every bank in the world, particularly the Western world, in more advanced economies, a spotlight was shone on them, because the people, investors that normally would lend money to the banks, didn't know which banks were actually holding, which banks around the world, which retail banks around the world were holding these mortgage-backed securities, and how much they had. So even ANZ, they had to pay a higher interest rate on their borrowing just after the GFC to reflect the potential risk that they posed to the people lending them the money, because those lenders just didn't know whether ANZ was exposed to this mortgage-backed security crisis and the GFC more broadly. And so it spread to banks around the world. Stock markets tumbled, particularly bank stocks. And then things just got worse from there. You can imagine the macroeconomic sort of flow-on effects. Growth slowed in countries around the world. Unemployment rates went up, etc., etc. But that is basically the story of the global financial crisis. So we come right back here to the East Asian financial crisis. This part of the story, it was in the late 1990s that these countries and China and the Middle East all started pouring money into US bond markets. Without that inflow of money, the US banks would not have had the volume of money that they actually had to inflate, to lend money to their customers, to then inflate asset prices, to kick off this dodgy subprime lending, and ultimately create the global financial crisis. So if it hadn't been just after the Asian financial crisis, all of these countries lending money to America, the GFC never would have occurred. Now, of course, what America did with all of that money that flowed in, you know, the pouring it into the housing market, the dodgy lending, what Wall Street did, all of those were contributing factors as well. Of course they were. But you've got to ask the fundamental question, where did the money come from to inflate house prices in the US, to then have house prices collapse and kick off the GFC? It came from all of those countries wanting to hold US dollars. Now, I'm not saying that that is to place most of the blame on those countries. Of course not. Wall Street was totally irresponsible in creating these dodgy mortgage-backed securities. And the car salesmen that were peddling these mortgages, equally as guilty. The credit rating agencies were an absolute disaster in terms of rating these mortgage-backed securities with very high credit ratings and giving the investors in these mortgage-backed securities a false sense of safety. So there's a lot of different things going on here. Now, you may have, there's about 2 or 3 really good movies on the on the global financial crisis. I can't remember the actors, I think, no, it's not Christian Slater. Oh, I can't remember the actors now, but there's quite a few movies that have been made with very good actors. If you watch those movies, now that you understand what mortgage-backed securities are and how it all works, if you re-watch those movies will make a lot more sense. Over the years, I have watched those movies with a couple of different people, and I've had to stop the movie and explain what was going on because there was a lot of sort of Wall Street talk. But it'd be interesting for you to track down one of those GFC movies and have another listen. And you should, after listening to this case study, understand what was going on in financial markets in those movies a lot more. So that's the global financial crisis.